Matthew Boersen is the founder and managing partner of Straight Path Wealth Management. He's passionate about helping business owners with complex financial situations reduce their taxes, plan for the future, and build long-term success. Ken Welch. Ken joined Straight Path Wealth Management in 2020 and has the unique distinction of being both a CFP and CPA. Ken uses his high-level experience and in-depth knowledge to provide innovative solutions to his clients' needs. Please welcome Matthew Boersen and Ken Welch.
Awesome. Thanks, Zach. If you want to go to the next slide, we have kind of three main goals we're going to talk about today. The first is going to be business structure. We're going to talk a little bit about taxes, and then we're going to talk about retirement savings. So we're going to kind of do three different kind of topics here. So first, though, and we've talked about this a little bit through a couple of the sessions already, but I think it's really important that everyone gets in the right mindset, which is that each one of you is actually really a small business owner. And that's a really important distinction, a really important mindset, because there's some key advantages and some key strategies that we can use for you guys that maybe aren't available for some other people who have primarily a W-2 income or a salary that they get consistently from a job. But with that also comes some complexities and some decisions that you have to make, and you have to be extra intentional and set some processes in place to make sure that you maximize those opportunities. So that's a little bit about what we're going to talk about. So first we're going to talk about business structure, and we're going to give just kind of a little bit of a high-level overview on kind of what the defaults are, and then specifically from a tax standpoint, what some of the advantages, disadvantages, or some of the just kind of assumptions are that the IRS makes for tax structure. So first, we're going to talk about sole proprietorships. This is the default. So if you choose to do nothing for your business, for you personally, with the commissions that you're receiving, the IRS, as well as the state of Michigan, will view you as a sole proprietor. This is the default. An advantage of being a sole proprietorship is just that it's easy. So it's easy, it's inexpensive to form because you really don't have to form anything. You're you. Because of that, you have complete control. And the tax preparation process at the end of the year for you is actually very simple. So we use what's called a Schedule C, which Ken will talk about in a second, which is just part of your normal personal tax return, a very simple, straightforward thing. We take the revenue minus some expenses, and then it reports through. There's a couple disadvantages, though, to this default option of being a sole proprietor. One of them is that you have unlimited personal liability. Now, you may have insurance and things like that help, E&O insurance that helps cover some of the things. But you yourself and the assets that are attached and the revenue that you receive has unlimited personal liability. The biggest one from our end is that you also remain fully susceptible to self-employment tax. And we're going to talk a little bit more about that and some savings that you may have around some of those strategies here in a little bit. A slight deviation from that is you can form what's called an LLC, or a limited liability company. This in and of itself doesn't necessarily change the tax structure at all. This just initially changes the legal structure, and then we can do some tax things around it. So by itself, an LLC really just does one thing, which it limits your personal liability by separating out some of your personal assets from your business assets. So if anything were to happen to your business, your personal assets would be segregated and potentially protected. You still would have complete control, and you still have easy tax preparation because from the IRS's perspective, they actually don't care that you formed an LLC. The IRS's perspective is an LLC is what they call is a disregarded entity, meaning that we still file your Schedule C just like if you were a sole proprietorship. So there's no change initially from the IRS's perspective. A slight disadvantage to an LLC is there is a little bit of an admin setup. So you'd file your LLC typically in the state of Michigan for all of us sitting inside this room. There's a little bit of paperwork you have to do. There's a little bit of annual filing fees. You have to pay typically $25 per year to the state of Michigan, and just a couple extra hoops that you have to jump through. The main disadvantage of a sole proprietor still stays, though, which is that the self-employment tax still exists. And if we back up and think about what self-employment tax is, this is something that's in addition to federal taxes and state income taxes. So if you were a W-2 employee, so if you worked for a large corporation and you got paid a salary, you know that you have to pay federal and state taxes, but you also have to pay something that's called payroll taxes or FICA taxes. And those are Medicare, Medicaid, and Social Security taxes. Well, if you were just an employee, what you may not realize is, yes, those things equal up to be 7.65% of your income. That comes off before federal and state taxes. But your employer is also paying 7.65% on your behalf. While, as a small business owner, you are now the employee and the employer. So you have to pay both. And that's what the self-employment tax is. That still exists if you're a sole proprietorship or if you're an LLC. So there's one more option that we can look at. This is a structure that takes a little bit longer to set up. There's a little bit more complexity behind this. You have to have some consistent revenue and consistent profits to make this worth it because of the hoops we have to jump through. But we can make an S election to your LLC, or we could form an S corporation. Typically, we'll make an S election to an LLC, which is when we ask the IRS to then change how you're taxed. So instead of everything being disregarded, instead of everything flowing through to your personal tax return on a Schedule C, now we'll change it and we'll create two different taxable entities. You'll still have yourself, but now we'll have a separate corporation or a separate LLC that files its own tax return. And when we do that, then we get to avoid, at least in part, some of the self-employment tax, because the profits coming off of a corporation or an LLC with an S election are not susceptible to the 15.3% self-employment tax. So we get to save quite a bit of money on that. You still get the personal liability protection inside an S Corp or inside an LLC with an S election on it. You still get complete control under those things. But there's a couple disadvantages, because this almost sounds too good to be true, right? If we could just tell the IRS and file one form, and the IRS says, yep, you get to skip 15.3% of your taxes, that'd be really easy, right? We'd all do that. But we have to jump through a couple of other hoops, because the IRS knows that that's a little too easy. One of the main administrative costs and burdens that we have to do is we then actually have to put you on payroll. So we have to truly start separating things out and treating it not just you, but we have to start treating it like a business and you as an employee of that business. So the IRS's rule is if you have an S election on your company, you have to then pay yourself a salary. So think about it, if you had $100,000 worth of revenue coming in, you might pay yourself a $50,000 salary, and then $50,000 would stay as the profit of the company. We wouldn't get any advantage for that initial $50,000 that you're paying as a salary. FICA taxes, Social Security, Medicare, and Medicaid still apply to that salary part. But the remainder, the part over and above that salary, is what we get to skip the 15.3% on. So it can be a pretty significant savings. Now, if you're just starting out, and you're just starting to build income as a realtor, not a huge benefit, because we got to pay that salary. We have some costs associated with it. We have to pay a payroll company to run them. We have to do some extra filings. There's some hassles there that make it not worth it. On our end, and every situation's a little different, but typically we say that $100,000-ish number is roughly where then making an S election on your LLC starts to become worth it. That's that kind of tipping point, where typically the tax savings that we see from bullet point 1 are worth the hassles of the disadvantages of point 2 or point 3.
Did you have a question? Oh,
We can stop here. Is there any questions just quick about any of the things that we just talked about? We'll have a bigger kind of Q&A at the end if you want. But
is the S election and the S corporation sort of the same?
Yeah, so there's two different types. There's a slight legal difference underlying it, and so depending on your situation, there may be a beneficial option to one or the other. But from a tax standpoint, whether we file a corporation and make an S election on it, or whether you have an LLC and we make an S election, from a tax standpoint, it's exactly the same thing. Certain attorneys will prefer certain structures depending on the situation, but the key in that is that we want to make an S election because that's what allows us to have separate taxation, and that's what allows us to save the 15.3% in self-employment.
So, and just to build a little bit off that, so an S corporation, you're going to have a separate business return, and that business return is going to kick out a K1 that you then recognize on your personal return. So you do have a separate business tax return, but then ultimately the income from that business gets taxed at your personal ordinary income tax rates. It's a huge benefit is this saving that 15.3% self-employment tax. All right, so now we want to kind of shift gears a little bit. We want to talk about taxes. I mean, you guys as small business owners, this is really important, right? So as we kind of go through this, I just want to give you a high level kind of understanding of just sort of basic taxes for those of you who are relatively new to this industry, and want to talk about a few maybe pertinent expenses, that we can kind of build on to make sure that you're minimizing your tax liability at the end of the year. All right, so first just want to show you this 1040 Schedule C. So if you file as a sole proprietorship or you are an LLC, a disregarded entity, all of your business activity is going to get reported on Schedule C, which is a schedule to your 1040, your personal tax return. Just want to point out a couple things here. So, for you guys, this top line, line 1 is gross receipts or sales. So that is the commission income that you get on that 1099 at the end of the year. That's where that's going to go. As far as kind of expenses that may be applicable to realtors, obviously we've got advertising, car and truck expenses. You guys probably have insurance costs as well as maybe some legal and professional. Office expenses may be significant for you. And then obviously travel and then related meals expenses. So we'll get into some of those and kind of break those out a little bit for you. So the first is vehicle expenses. You guys probably know this, but you have to track your business and your personal mileage on the automobile that you use, for your business. This is really important, and if you ever get audited, the IRS expects that you have written documentation of your business miles. And so there's a lot of ways to do that. Some people use just an old-fashioned paper log, but that's fine. There's a lot of apps out there now that you can download on your phone to kind of automate this. Some of them are integrated with QuickBooks Online if you use that as an accounting software. But these apps, it's as easy as you getting in your car, hitting, hey, I'm on a business trip, start. It'll track with the GPS on your phone, it'll track how far you go and then kind of get in your mileage. So regardless of the sort of vehicle expense method that you use, you need to track those business miles. The first and probably most well-known approved method is just the mileage method. In 2022, they actually raised the mileage rate mid-year. So halfway through the year, the mileage rate went from 58 cents a mile up to 62 cents a mile. I think the IRS saw what was happening with inflation and the price of gas, and so they increased it. So this year, for 2022, you'll actually need to break your mileage up into 2 categories. You'll need your mileage from January through June, and then your mileage then from July through December. If you decide to use the standard mileage method, you can see in 2023, it increased a little from 62 cents a mile up to 65 cents a mile. For a lot of our tax clients, the standard mileage method makes the most sense, especially if you're driving a lot of miles. Because a lot of times the standard mileage method, one, you don't have to keep track of every receipt related to your vehicle. But then also if you're driving a lot of mileage, that deduction or that expense that you use to offset your income is larger under the standard mileage method than if you use actual expenses. So that other option, actual expense, is when you actually track all of the expenses related to your car. So your gas, your oil, your car washes, any maintenance, all those things. And then what ends up happening is you take a percentage of your business mileage versus personal. So say you drive your car 60% of the time it's their business miles. So you would track all these expenses related to your automobile. Say it's $5,000 a year. Then $3,000 or 60% of that would be your vehicle deduction for the year. Does that make sense? So next is home office expenses. There's 2 basic requirements here. One is that the space you use in your home it's for regular and exclusive use, meaning that it's only used for your business. So if you work from your kitchen table at home and you don't have a dedicated office space, that's not exclusive use space. You can't take a home office deduction. And it's got to be your principal place of business. So if you do have an office at the brokerage or an alternative office that you spend time at, you can't take the home office deduction either. So there's a couple, again, here with the IRS, they always make it a little bit complicated, multiple methods. The first is the simplified method, where basically you just take the square footage of that dedicated exclusive use space, and you get to multiply it by $5 per square foot, and that's your deduction. So think about that as similar to kind of like the mileage method. There's just a standard rate you apply to your home office space. The other method, the regular method, is when you actually track all the expenses of your home, and then you apply basically the pro rata space used for your office versus the space of your entire house. So for example, say you've got an office that's 200 square feet in your home, and your home is 2,000 square feet, right? So 10% of your home is allocated to your home office. So throughout the year, you would track all of your expenses, right? So you've got property taxes, you've got utilities, you've got your internet expense, all of those things. And then at the end of the year when you're filing your taxes, you say, okay, 10% of my home is dedicated to the office, so I can write off 10% of the expenses, essentially, of having my home. On this one, it kind of depends. We're probably 50-50 with our clients. Often it makes sense to just kind of do an analysis. Hey, what would my home office deduction be under the simplified method? What would it be kind of under that regular method? And then this final bullet point down here, S-Corps, you're not allowed to claim home office expense. So if you got an S-Corp and you solely operate out of your home, it doesn't matter, you're not allowed to take that home office expense.
Why is that?
That's
a good question, actually.
The short answer is it's just the IRS, and I feel like they make things complicated. But I think the somewhat logic behind it is the fact that with inside of Schedule C, the kind of how the business use of home works is it reports through on the Schedule C. We don't have a Schedule C anymore when you're an S Corp. There's some things that we can do to kind of adjust it, so we can have the S Corp technically pay rent to yourself for some home offices. There's kind of some more advanced strategies we can use. There's a Section 208A which allow actually for some tax-free payments from an S Corp to your individual up to a certain level. So there's a couple small things we can do, but it looks way, way, way different, and there's just some caps associated with it. And I think at the end of the day, it's a little bit of probably just an anti-abuse privilege, where the IRS says, hey, if you're going to get this, like there's some simplicity there. It needs to operate more like a business, and a home office deduction in and of itself, it doesn't do it. We used to be able to, even with an S Corp, take what's called an unreimbursed employee expense as part of an office deduction. They got rid of those back in 2019, I think. That was one of the give and takes between adding something called qualified business income deduction, which most of you probably get in this room, which gives you a 20% deduction, but then you lost the home office deduction. So they're always changing these things. We're going to talk about something here in a little bit that they changed on us 2 weeks ago. So they're constantly changing rules, and that was just one of the adjustments that they made back a couple years ago.
Perfect. I apologize. I realize I have not been using my mic. So for anybody who's watching this in the future, the tape version, sorry for the audio right there. That's right. Okay, so then just wanted to kind of have another general, more of a catch-all category. So other business expenses. Obviously, there's a lot of expenses that you guys incur as you operate your business. The basic rule for deducting, or the rules for deducting any expense is it's got to be ordinary, necessary, and related to the business. One of the big ones for you guys is probably business meals. In 2022, those are still 100% deductible. In 2023, that kind of phases out a bit and it goes back to its normal 50% deductibility limit. So just something to kind of think about as you're moving into 2023. And then the last one there, entertainment expenses are not deductible. There's no percentage of those that is deductible. However, if when you're entertaining, there's a meal aspect to that, make sure that you keep those receipts because we can still take the meal deduction on that piece of it. So say, for example, you take somebody to a Griffins game. The tickets for the Griffins game are not a deductible business expense, but you grab a hot dog and beers while you're there, that particular piece of the expense would be deductible in 23 at a rate of 50%. Yeah.
With something like a client appreciation party, is it still, is there a way that you can classify it as such under, it looks like an entertainment, and I'm sure that's all the IRS cares about. Is there a way that you can classify it as such so that it could be potentially deductible?
Yeah, that's it. I think that's a good
You
question.
might get a different answer from the CPA than from me on this one, David.
We're getting okay.
Hopefully that one's
That's
not
a
on the
great
table.
question. We're getting into a level, I think, of gray there, because client appreciation is something that could be ordinary, necessary, and related to the business, depending on the type of business that you're in, right? So if you're hosting an open house, right? And I know people got kind of creative over COVID, right? So people were buying these like smokeless fire pits and having them out in the driveway and doing different kind of cool things, you know? And so those expenses would be business related expenses, even though they may seem slightly on the line of entertainment. But you got to be careful with it. And so that's my kind of maybe disclaimer as a CPA. Matt, do you have?
There's a little bit of gray area to this. This was another one of the changes. I mean, so previously entertainment expenses by and large were deductible up until 2019. That was a big change. For instance, golf courses were really upset with this, right? Because then country club memberships, golf for clients, things like that were no longer allowed. I will tell you that like we do client events for our clients. So we did like a painting event a couple months ago, and we are deducting that because that was very clearly kind of advertising referral. And it was more of an event we threw as opposed to straight up entertainment where we're just taking someone to a Griffins game or taking them to golf. So if it's a big kind of party event, that sometimes we can classify that a little different than just true entertainment. Hey, I'm taking somebody out. For a game. Part of the kind of logic again behind that, not that it's always logical, but part of the logic was people were using it more for themselves than necessarily for the business. That's the mindset too behind the normal rule, which is 50% deductibility for meals, not 100%. The 100% was that kind of special thing that we had going for a couple of years. Normally it's 50. And it's that you're getting some benefit from it. So if you're getting some benefit from it, that probably isn't actually a business expense, that's more personal, right? And so that's kind of the thought process behind a lot of these. But there is certainly the line sometimes between entertainment expenses and advertising sometimes gets a little blurred. Yeah.
See, I would say golf course would work if you're looking at it from a prospecting perspective.
Yeah. The problem is they said specifically, the IRS has come out specifically and said no golf, unfortunately. That was like a very, very specific rule. Otherwise, I'd agree with you, I guess, but that's actually been one of their examples, and because the IRS does put out Q&As to help understand some of the thought process behind these rules, and golf courses is one of the things that's been pretty explicitly stated. Golf just doesn't work. So, but ironically, if you buy beers on the golf course, you can do that, right? So that's like kind of a weird thing. So,
Yeah. Well, good question. And we appreciate the question. So as you guys are thinking through your personal situations, if you have questions like that, please just shout them out. We're happy to kind of walk through that with you. So, all right. So self-employment tax, Matt already talked about this a decent amount. The big piece to remember here is when you're a business owner, you are paying both the employee and the employer's share of those Medicare and Social Security taxes. It's an additional 15% above what you're paying in your ordinary taxes. Okay, self-employed health insurance deduction. So you as a self-employed person can deduct health insurance premiums for yourself up to the profitability of the business. And I just put that kind of qualifier in there because if you're just starting up this year and you get health insurance off of the exchange and say you pay $5,000 to cover yourself, if your business is not profitable, you're not going to get an additional write-off, in addition to the loss you already have from your business. Now, say it's your first year and you've got $10,000 in net income, we are able to use that $5,000 of self-insurance premiums to offset some of that income. So just something to kind of consider as you're getting started. QBI, qualified business income deduction. This is fairly substantial for most of our clients, and you guys as realtors and business owners should be taking advantage of this. This is essentially a 20% deduction to your business income that comes out kind of below the line. So there are some phase outs here. So for single filers, if you're making over $170,000, QBI is going to start to dwindle and then eventually fully phase out at $220,000. And then as a joint filer, that phase out starts at $340,000.
that was the trade-off we got for some of those stricter rules, the no entertainment, some of that stuff, is it was the same tax bill that when we got QBI, when we got the benefit of QBI, we lost some of the things like entertainment and some of those write-offs that were maybe a little, that sounded really good. But in our experience, this is bigger, right? So if you have a profit of $100,000 from being a realtor in a year, we get to just basically take $20,000 and exclude it from your tax return, and you only end up paying taxes on 80. It sounds too good to be true. It's meant to level the playing field with you as a small business owner comparative to big corporations. And so it's huge. It is a really, really, really big deal. It's really important. And it's largely automatic as long as you fall within or below those phase out limits that Ken mentioned earlier.
Okay, so federal estimated taxes, for those of you who are new to owning a business, the IRS essentially expects that you make regular tax payments throughout the course of the year, right? And ultimately, most people's goal with their federal estimated taxes is that they spread out what they think they're going to owe in taxes over 4 quarters, and they pay it evenly over the course of the year. And then in an ideal world, you get to the end of the year, and essentially you're break even. You owe $20,000 worth of tax, but you've paid, 4 quarterly $5,000 estimated payments. With estimated payments, it's really important to think about what the IRS deems safe harbor amounts. So as long as you make estimated payments and they meet the safe harbor criteria, the IRS cannot charge interest and penalties for underpayment of taxes throughout the course of the year. Now, if you hit these safe harbor amounts and say you have a great year, where at the end of the year, I made my estimates based on last year's income, but I still owe another $20,000 worth of tax. Even if you've hit those safe harbor requirements, the IRS still cannot charge any interest or penalties against that additional $20,000 of tax owed that you didn't pay over the course of the year. So it's really important to think about that and make sure you're kind of hitting these safe harbor thresholds. So the thresholds are 90% of your current year tax. That's kind of a tricky one because for most people, they don't know exactly what their income is going to be at the end of the year until it's the end of the year. So for most people, the way it works is they end up paying 100% of your prior year tax and those quarterly estimated payments throughout the course of the year. Now, if you're a high earner, and your AGI, your adjusted gross income, is over $150,000, the IRS actually expects that you pay 110% of your tax over the course of that year. And then down here, we've got some penalty percentages. Don't necessarily expect you to know or remember those, other than hit your safe harbors and you don't have to worry about the penalties and interest and all that kind of stuff. The other thing, and you'll see this when we get to the state side, the federal penalties and interest are much less than what the state penalties and interest are. So if you're ever at a point where just from a cash flow standpoint, you've got to pick, hey, should I make my federal estimated payments or should I make my state estimates? Always make your state estimated payments. Again, so with Michigan state estimates, the rules are actually identical to the federal estimates. And then on the penalty side, here you can see the percentages are much higher than what those IRS percentages were. So again, ideally you make safe harbor payments for both Fed and the state, but if you have to pick one, choose state. Okay, retirement savings.
Awesome. All right, so one of the realities of you guys being business owners too is that you guys have to do your own retirement savings. Nothing is easy for you guys. If you worked for a big employer, they might provide a 401k, they might provide a pension. None of those things are automatically set up for you guys. So you guys have to do a little bit of the extra legwork and do some of this yourself. There's a couple extra options available to you, which we're going to hit on here in a second, but it does take a little bit of extra legwork and a little bit of extra work and a little bit more initiative from you guys. Just from a background standpoint, retirement savings are, of course, really important. It's really easy to think that you're going to be able to do this until you're 80 or 90 years old. Some of you may not want to do that, and you may want to end earlier. But the reality is also that sometimes you can't do that. Health issues pop up, things like that. And so it's important to at least have a retirement plan in place, even if you don't want to retire until you're in your 70s or 80s. One of the things that people think from a retirement standpoint is, well, Social Security will just take care of me. I've paid a bunch of taxes into Social Security. That will surely be enough. But the reality is that typically for the average retiree, Social Security only provides about 40% of their working wages. So that's just not enough. So there's got to be something else that you're doing. There's got to be some additional savings if you want to actually be able to retire successfully. The nice thing is the IRS gives us some advantages. So if you do and are willing to save for retirement, there are a lot of tax opportunities out there where we can either lower your taxes or save you taxes in the future by being able to save for retirement. One of the benefits is that it obviously avoids you becoming a burden to your dependents. So what we've seen and what we're seeing, actually a little bit of a, research is telling us we're seeing a little bit of a growing trend of this right now, is a lot of parents are having to move back in with their kids due to health issues or whatever it may be. And part of that is because they didn't save enough, right? And so then their kids are the ones that are having to step up and potentially take care of them. And then it's never too early to start saving for retirement. The power of compounding, which Ken's going to talk about here on the next slide, the power of compounding is huge. So the earlier you can start, the better, is a really, really important part.
Yeah, they say pictures say 1,000 words, right? And so I think understanding graphically kind of the importance of saving early is really important. This example was actually taken from the Dave Ramsey Solutions team. So Straight Path is part of the Smart Vestor program. And so anyway, just wanted to kind of use this quick visual to show you guys the importance. So two scenarios here. We've got two people. We've got Ben and then we've got Joey. Ben starts investing as soon as he gets out of school at age 21. He saves $2,400 a year from age 21 to 30. So he's got 10 years, 9 years of savings, right? And he stops saving at the age of 30. Right, so he's got this $21,000 nest egg that at age 30 he's basically just going to let ride. And then we've got Joey, and he started a little bit later. So he's starting at age 30. He's going to save that same $2,400 each year, and he's going to save that until he reaches age 67. So his total savings is just shy of $90,000. So when we come over here to this example, you can see, so Ben, again, he stops right here at age 30. His ending nest egg is $2.1 million, and he saved a total of $21,600 by age 30. Then we've got Joey, who started 10 years later, and he invests his whole life until he retires at age 67. His retirement nest egg is half of what Ben's is. And the reason that is, it's that power of compound earnings, right? So when you look at this graph, this is an exponential return. It's not just a straight line return, right? So you can see here for Ben, at age 60, his portfolio is about, right here, this dot is about 1.2 million. So he's got about the same portfolio size as Joey at age 60. Now look what happens these last 7 years. He goes from this 1.2 million up to 2.1 million. Because that's the power of that compound earnings over time. And so as you look at this, we present this to encourage you to start saving early. If you haven't done that, we don't want to discourage you because it's still very important to save for retirement. But just wanted to kind of visually represent that. So we've got a couple different options for retirement savings, as Matt kind of mentioned earlier. The first is the traditional IRA. So this is an individual retirement account. And Matt mentioned kind of some of the tax benefits of retirement savings. So in an IRA, anybody can open one of these. For an individual, the annual max contribution in 2023 increased to $6,500 a year. These are pre-tax savings, meaning that you get a tax deduction for every dollar that you put into this IRA. So if you contributed the maximum amount of $6,500, you would essentially offset your taxable income by $6,500 a year. So not only are you saving on the tax side, so maybe you're in the 22% tax bracket, you save 22% tax, that's an immediate return for the money that you put into this IRA, and now you've got money that's going to grow for you into retirement. So the tax benefit is huge. The future retirement benefit is significant as well. If you don't have other employment, other savings opportunities, if realty is your main thing, there is no income limit on being able to contribute to this IRA. And then because this is a retirement savings account, the IRS expects that your money stays in that account until you're age 59 and a half. Otherwise, there's some penalties on early withdrawals. With a traditional IRA, similar to a 401k, there are required minimum distributions. So prior to 2023, the RMD age was 72 for everybody. Now with Secure Act 2.0, they've actually extended the RMD ages out. So you can see now we've got these buckets at 72, 73, 75. If you were born in 1950 or earlier, your required minimum distribution age is 72 because you are 72 right now. And then for anybody born in 1959 or later, which is probably most of this room, you're going to fall into that 75-year-old category. So when you turn 75 years old, the IRS is going to require that you take money out of this account. Now, when you put the money in, you got a tax deduction. So when the money comes out of the account, when you withdraw it, it's fully taxed at your ordinary income rates, which is why the IRS puts these RMD requirements in place, because they want you to pull that money out and receive the tax benefit that they didn't get on the front end, essentially. When you turn age 75, the RMD percentage of sort of the total investment is around 4%, just to kind of give you an idea. And as you age, that RMD percentage continues to increase, so the IRS wants you to draw more and more out of your account. Any questions on an IRA? Okay. So a Roth IRA, you've probably heard a lot about this, especially if you listen to Dave Ramsey. But these are after-tax contributions. So in this particular scenario, you put after-tax money in, meaning you don't get a tax deduction when you put that money into the account. However, the money grows and has earnings over time, and when you pull it out in retirement, zero tax. You don't pay any tax on any piece of what you withdraw out of there. For the Roth IRA, there actually are some income phase outs to be able to contribute to the Roth. So as a single person, those start at $138,000. As a joint person, or if you're married filing joint, it starts at $218,000. Mentioned distributions being tax-free. And then with a Roth, the other big advantage there is no required minimum distribution. So when you reach age 75, you can continue to leave the money in there. If you don't need that money, you can continue to let it grow. So, any questions?
So those two, the IRA and the Roth IRA, are largely available to anybody. But you guys as business owners get access to a couple other plans that you can start up that are a little bit more unique just to business owners. And the one that we see used most often in this industry is something called a SEP IRA. It'd be great if SEP stood for self-employed person. It doesn't, they make it a different thing, but we like to think of it as self-employed person IRA. The main benefit of a SEP IRA is that the potential money you can put into it is bigger than what a normal IRA is. So for an IRA, like Ken said earlier, it's $6,500 for 2023. The max for a SEP IRA is actually $66,000, so it's significantly bigger. There are some calculations that we have to do. So 66 is the hard cap, that's the hard dollar amount cap. But we have to, there's a couple other classifications where it's the lesser of $66,000 or 20% of your business income, if you're a Schedule C business. Or if we did make an S election, you can put up to 25% of the salary that you're paying yourself from an S Corp, you can put into a SEP. So we have to look at the lesser of $66,000 or 20% of your business income on a Schedule C. It does work just like a traditional IRA, so that first slide that Ken showed, which is everything goes in pre-tax. So when you put the money into the SEP IRA, we get to deduct that on your tax return. You get to save taxes immediately on that. The growth inside that account is tax deferred, so you don't have to pay taxes as that account grows. But then when you take the money out, likely in retirement, then when you take the money out in retirement, then you do have to pay taxes when it comes out. So the main benefit is the fact that probably right now you're paying a higher tax rate because you're working than what you would in retirement. So we get a deduction on a higher rate. We get all the growth to be tax deferred. We don't have to pay taxes for years and years and years. And then hopefully we pay a really low rate when you take it out. If you do have employees, so if anybody here has an employee that directly works for them, that they are on a salary with them, you do have to offer this to employees. So if you're just on your own, if you don't have a business where you have people reporting to you that you're paying, you don't have to worry about the second bullet point, but it is a technicality that if you have other employees, you have to include them on the SEP. And then distributions are subject to tax. Just like an IRA, you can start beginning them as early as 59 and a half. So even if you haven't fully retired, you can start taking out penalty-free distributions at 59 and a half. The same required minimum distribution ages apply. So depending on when you were born, 72, 73, or 75. That's not a misprint. 74 is not an option. 72, 73, or 75. And then one of the things they changed 2 weeks ago, and this is actually a huge benefit. This is something that we're really, really excited about. From the beginning of SEP IRAs, they only had the option for traditional, meaning that you put the money in and you took the tax deduction now, but then you paid taxes later in retirement. One of the things that they just passed a couple weeks ago, we're actually still waiting for the IRS to issue final regulations, but it starts this year, is you can now actually contribute to a Roth SEP IRA, meaning that instead of taking the tax deduction this year, you don't take a tax deduction, but then all the growth inside that account is never taxed. It gets to grow completely tax-free, and you get a big benefit for that. You can save a big pile of money and get a bunch of gains without the IRS ever getting to touch them.
I think that's it for the presentation. And one of the things, I guess, to kind of give you guys a little bit of sort of recommendation on the Roth versus sort of the traditional contribution retirement options. When we make that decision of kind of what's the most tax efficient way for you guys to save, we look at what is your income tax rate now versus what do we expect it to be in retirement. So if you're just starting off and your income tax rate is really low, say you're in the 10 or 12% income tax bracket, we would highly recommend that you guys save in a Roth vehicle because you're going to forego current tax savings. But then when you pull that money out in retirement, when maybe your tax rate is higher, maybe it's at a 15 or 20% rate, we're going to get tax savings then, right? When we withdraw that money and you're at a higher tax bracket. And then sort of the flip side of that coin is also true. If you are at sort of peak earning years and, right now you're in the 24% tax bracket or up north of 30%, we want to take that pre-tax deduction on those savings now because your tax rate is so high, and then we're okay paying tax on those withdrawals in the future because in retirement your tax rate is likely much lower. Maybe it's 10 or 15%. So we're always kind of weighing the balance with those two. Any questions? Anything you guys heard today or anything specific to your business? Yeah, Zach.
On the compounding slide,
Mm-hmm.
it said assuming an annual 11% return.
Mm-hmm.
Obviously averaged out, it could land around that. What vehicle were we in that we can accumulate something around that? Or what, at least for what vehicle were those numbers pulled from? Is it Roth, a regular IRA?
Yeah. So that 11% return that's an aggressive return, meaning that is going to be an equity stock-based portfolio. And I think Ramsey Solutions uses that to just kind of highlight the significance of the compounding. We've seen that. So the S&P 500, for example, that's stock in the 500 largest companies in the U.S. From its inception in the 1920s through 2020, the average return has been 10.3%. So yes, that's an equity-based return. Our general rule of thumb in financial planning is that your money doubles every 8 to 10 years. And so in that particular example, I forget his name. I think it was Ben. Ben's money doubled in about 7 years. So that was a fairly aggressive rate of return.
And the important thing to remember is, unfortunately, we wish it was just 11% every year, right? But when we're investing aggressively like that, one of the benefits that both of those projections had is that it's over long time periods, right? So we're pretty comfortable saying, hey, we think we're going to get a really good return long term in the stock market. But if you asked us, can we tell you for sure that you're going to get 11% this year in 2023 or 2024 or 2025? We'll tell you no, right? So there's going to be lots of ups and downs. And so we have a year, we had 2020 and 2021 that were huge, 20+% year growth in investments. And then we just had 2022, which saw at one point we were down like 25% inside the market, right? And so you have this roller coaster. And so, what fits for you guys is going to be very specific, right? It's going to depend on your age. A 25 or 30-year-old is probably going to invest very differently than a 60 or 65-year-old. And it largely is based on when do you need this money. The actual investment return itself, though, doesn't necessarily matter what type of account. So like a Roth IRA versus SEP versus a normal investment account, those are just the tax treatments. The investments could actually be identical in any of those, right? So we could own actually the same investments inside a traditional IRA, a Roth, a SEP, or just a normal investment account. The investments could be identical. The difference in those vehicles is just the taxation treatment that the IRS gives, and when we get the tax breaks and when we have to pay taxes on them.
Go ahead.
For quarterly tax payments, does when you earn your money play into that at all? Like if all of your earnings basically came in the last quarter?
Yeah.
It can, it can. If it's really backloaded, then we can file like a special form with the IRS and say, hey, do not charge penalties as if this was earned equally. So the IRS's assumption is that you earned it equally in all 4 quarters. So if you earned $20,000 total for the year, they're assuming you earned $5,000 in each quarter. If that's not the case and that's not true, specifically if you earned it at the end, we'll probably just let the IRS assume that if you earned it all in the beginning, right? But if you earned it in the end, then we probably want to tell the IRS, and they'll reconfigure the potential penalties or the interest that they charge in that scenario.
So you just need to make sure you disclose it, because the IRS is going to assume you earned it evenly. Yeah, Zach?
Is it simply the I guess what are the differences here if, let's say, I like trying my hand at investing, basic S&P kind of thing on my own. An IRA or a retirement account, SEP, those are just going to help protect me, right, long term and taxes, versus me just trying to do it on my own. Would that be the benefit of trying to do that, or would I be better suited if I'm savvy enough financially in the markets to take that money and start doing it myself?
And you could start your own IRA. So having an IRA or a Roth IRA or a SEP IRA does not have to come through an advisor like us. So that's just the tax treatment, right? So if you wanted to at Fidelity or Vanguard or any of those places, if you wanted to go, you could open up your own traditional IRA, your own Roth IRA, your own SEP. It's just changing the taxation and how the IRS views it. So if that's something that you're passionate about and super knowledgeable about, then that is something you absolutely could go do, right? And you could go pick the stocks. I mean, there are, technically from an IRS standpoint, there isn't really very many limitations on what investments you can hold inside those things. There's some limitations around cryptocurrencies. There's some limitations around certain types of collectibles. But as far as like a stock standpoint, you can basically hold anything inside those accounts. So if that's something that you want to do, you can absolutely go do that on your own. It's super simple. Through Vanguard or Fidelity, it's no different opening just a normal investment account versus an IRA. It's just you check a different box when you're opening the account. If working with an advisor is not necessarily the availability of those accounts, because those availabilities are always available to you, right? It's then we help you then pick the investments inside there, make sure that you're correctly invested for what your goals are, and then provide the financial planning and the tax support around it too. Because one of the ways that we're maybe a little unique comparative to most financial planning offices is that we have the tax piece built right into everything that we do. So it's not just retirement and investment savings in a vacuum. We're building the tax planning, the tax preparation. So we do 550 tax returns every year for our wealth management clients. That's a big piece of what we're doing for our clients, and it's married all together. Because as you can see from the different types of accounts, to do retirement planning absent tax planning doesn't really make a lot of sense, right? Those two things have to be together if you're going to maximize your benefit, especially when it comes time to distributions, especially when you're actually in retirement and getting ready to take money out.
But that's kind of normal for
Correct. So
Tax people are tax people.
tax people are tax people. And we started, so when I founded the company 11 years ago, we started as a financial planning company, right? And we didn't have the tax piece. Part of the reason we started the tax piece like 8 or 9 years ago was because they were completely bifurcated. And the clients ended up getting very frustrated because they were trying to talk, they were trying to get their CPA to talk to their financial advisor. They calling to talk different languages. This is not completely anti-CPA. It's slightly generalization because he's a CPA. But CPAs, tend to be very focused on reporting the numbers and making sure that it's accurate from a tax return, which is very important, super important. They tend to not be as focused on how do we then save taxes for the next 3 to 5 years. And we just kind of kept feeling like we were being our head against the wall. Right.
Yeah, they
Right.
got everything in the right box, and yeah.
And so that's why then we kind of built it into our process. So then part of our thing for our clients is we're running 5 to 10 year projections, especially when we get closer to retirement, on what is the optimal kind of balancing here, what's the best way to do these. And then again, specifically in retirement, when we start taking money out, it's not hard to save $5,000, $10,000, $15,000 in taxes based on how we orchestrate withdrawals inside retirement.
Now this isn't more of like a question, but it's more of a general comment. So I know a lot of you guys work with listings and selling people's homes. One big thing I think with the investment piece is you have the power to kind of help your client think about what can I do with this money, not just on purchasing that next house, but if somebody owned a house for 5 to 7 years, think about how quickly that return on investment grew. What could they do with that compounding interest in the future? That's a big thing I look at with clients is how do you're selling your house, you're making $150,000 from this. A lot of people think, I just have to move this over. But if you talk to them beforehand and say, hey, have you talked to a financial advisor about this? I've had so many of my clients go to you guys, to their financial advisor, and that can change their life from there, just with that compounding interest, especially if you get them when they're younger. So that's just more of a comment, but I found that's a huge opportunity just to really kickstart somebody's retirement and their investment planning.
Yeah. Thank you. Yeah, that's a great point. If you've got people that are downsizing, or even just understanding their financial plan, so knowing are they going to be financially set in retirement, and if they took maybe some extra cash from the sale of their home, this is how much it could help them when they get to that point where they're stepping back and retiring. So those are things that we love to do. Thank you. All right. Well, we'll be available right now after the presentation. So if you guys have specific questions about your personal situation or your business, we'd love to talk to you. So thank you.